Foreign institutional investors (FIIs) are entities or individuals residing outside India who invest in the Indian financial markets. This term is predominantly used in India to categorize foreign investments in domestic financial assets like stocks and bonds. FIIs encompass a wide range of global financial players, including sovereign wealth funds, pension funds, mutual funds, hedge funds, and insurance companies. Their investments are crucial for the Indian share market as they bring in substantial foreign capital, thereby increasing market liquidity. When FIIs buy, it infuses foreign currency into the Indian economy, strengthening the rupee and bolstering forex reserves. This influx of capital can fuel economic growth by providing businesses with access to funds for expansion and innovation. FII activity significantly influences stock prices and overall market sentiment. A robust inflow of FII funds tends to push benchmark indices like the Sensex and Nifty upwards, creating positive sentiment among domestic investors as well. Conversely, a sudden outflow of FII funds, often triggered by global economic uncertainties or domestic policy changes, can lead to sharp market corrections and increased volatility. Historically, India, being an emerging economy with high growth potential, has been an attractive destination for FII seeking higher returns compared to developed markets. However, the Indian regulatory bodies, primarily SEBI and RBI, have set limits on FII investments to maintain market stability. For instance, FIIs are generally restricted to a maximum investment of 24% of the paid up capital in an Indian company, though this limit can be increased with board approval. The investment decisions of FIIs are based on various factors, including global liquidity, interest rate differentials, economic growth prospects, inflation, and political stability in India. For example, if interest rates are rising in developed economies like the US, FIIs might pull funds out of emerging markets like India to invest in safer, higher yielding assets back home. FIs also contribute to improving corporate governance in Indian companies. Their rigorous analysis and demand for transparency often led to better financial practices and accountability from the companies they invest in. While their significant presence can lead to short-term volatility, the long-term impact of FIs is largely seen as beneficial, contributing to market depth, efficiency, and overall economic development in India. They act as a critical bridge between India's financial markets and global capital, fostering competition and aligning asset prices with fundamental values.